Hey Dividend Chasers, it's a Dividend Bloodhound here. Welcome to another investing episode. Today's episode we're talking about the biggest UK stock that I bought this week, hoping to add passive income to my FREETRADE ISA. If that sounds like something you're interested in, do please smash that like button and consider subscribing to my channel, and I will see you on the flip side of the intro. Catch you there. Hey again guys, welcome into the episode. As I said, today we're talking dividend stocks and my UK stock addition that I'm adding to my portfolio this week, and that is a high quality, great value company that I've bought right now, and that is GlaxoSmithKline, ticker GSK, also known as GSK for short. This is a high quality company with fantastic history and very dominant within its sector. GSK is a global healthcare and pharmaceutical company. It has numerous sectors including drugs and medicines, vaccines, over-the-counter regular healthcare products such as toothpaste, mouthwash, creams, just things that regularly help to get you by in daily life. And I can almost guarantee that you will have one product or another from GSK in your home. The company has a market cap of some £68 billion and is currently trading at a share price of approximately £13.70. That is down over 20% on its 52-week high, and to me represents significant value at the moment. The company has a 5.74% dividend yield that has been grown or held for over 20 years. Specifically over the last 4 or 5 years it has been held at present rate, and that is merely because the dividend yield is as high as it is, especially with the share price as low as it is as well. As a dividend income stock, this company is absolutely brilliant. It is dominant within its sector. The dividend has been paid for an extremely long time. It pays particularly well, over 36 pence per share. So each time you buy a share, you are building that juicy passive income, which is what you want. And getting up there for a 5.5% yield, that is pretty good, but without being too good that it's at risk of being cut. Revenue is an impressive £34 billion and an EPS of £1.36 and a PE ratio sitting at the approximate 10 mark. Net income was £6.37 billion with a large, very good profit margin of 18%, which is very impressive across the board. The company is highly profitable. However, in recent quarters and the most recent quarter, revenue has fell by 7%. Now, with the global pandemic in place, this isn't entirely surprising, and it's also not surprising for such a large company to sort of stagnate as it dominates its market and as it looks for new revenue streams, because it's already dominant in the sectors that it's already got. So this frankly isn't all that surprising. I would start to get worried if its revenue started declining by double figures or by 20% or more, but at the moment with the global pandemic I don't think this is too bad at all. The dividend, and this is what this company is all about, is very well covered, 1.59 times over, and as we know as dividend investors we have to have dividend cover of at least 1, because if that isn't the case then the company is having to look elsewhere or get itself into debt to pay its dividend. Obviously the higher the coverage the better, but 1.6 times over is typically quite average for the company within this sector and across the market. For me, the company is obviously a buy, and there are numerous reasons for it which I've already sort of highlighted. A nice high sustainable dividend yield and dividend payout. The company is extremely profitable. It has a fantastic dividend history, and it is a low volatility stock where the share price isn't going to be bouncing around all over the place. And at the moment, based on it being 20% down on its year high, I think it is a fantastic time to get in on this company and average down to the position of approximately £13.70 a share. £14 a share is absolutely fine and where I want to be. I'm looking to build a significant position in this company. Seeing this as a definite income stock and then using that income to buy, yep, you guessed it, more shares in exactly the same company, increasing the dividend that I get each quarter, and then snowballing this effect and buying even more shares in the same said company. I expect GSK to be completely capable of maintaining this dividend for the foreseeable future and for the years and decades ahead. I have no qualms in holding this company for the long term and using the revenue generated from the dividend income to reinvest straight back into the company. Do let me know your thoughts on the company below. If you think that I'm wrong, then I'm happy to have a discussion with you, or also let me know if you're going to buy into the company as well. That would be really interesting to have that discussion. It's been an absolute pleasure to bring this video to you, of course. I would massively appreciate it if you could see your way to smashing the like button if you haven't already, or consider subscribing to my channel, or both. Thank you very much for watching, guys. Hopefully I will see you in my next investing episode. Catch you there.